This training session is a crash course in accounting. This course is also found in Help under the heading Bean Counting 101. This course is intended as an introduction to the basics of accounting. CPAs and other professionals who might be offended by the title Bean Counting 101 can be assured that this is not a course intended for them. In the days of old, accounting was literally done by bookkeepers writing in books. These were called journals and ledgers. In these days of computers, anyone with a computer and accounting software can do accounting. However, having a computer and accounting software does not guarantee that we understand accounting. So we need to understand what accounting is, how accounting works, what debits and credits are, what journals and ledgers are, what a balance sheet is, what an income statement tells, and what accounting information reveals. Now, exactly what is accounting? Well, first, it's a numerical history of our business. Second, it's a photograph of our financial status. And how does accounting work? Business transactions are entered into our books, and each entry has two components, a positive and a negative. The positive part is called a debit. The negative part is called a credit. This is known as double entry bookkeeping. It works because the positives are always equal to the negatives. That keeps our accounts in balance. So let's see what this means. Let's start a business. We'll start with $20,000 in cash. Great! Now, how do we account for it? Before we can start, we need a chart of accounts, which is nothing more than a listing of the categories for our assets, such as cash, equipment, and the like, liabilities, such as accounts payable, loans, debt, and the like, income, such as sales, and expenses, such as payroll, rent, and the like. Before we go on, let's compare a debit and a credit. All of our transactions will have two entries, the debit and the credit. And we need to remember that the debit is the positive part of the transaction, and the credit is the negative part of the transaction. Now, back to the $20,000 we started our business with. We need to debit cash, and we need to credit equity. Well, what is equity? If we are a corporation, equity is common stock or capital stock. If we are a proprietorship or a partnership, equity is owner's equity. We didn't list equity as a category of accounts before. Equity is a special kind of liability. Equity is the amount a business owes to its stockholders or its owners. So we have $20,000 to account for. Our entry is to debit cash for $20,000 because we added $20,000 in cash, and we will credit common stock for $20,000. Debits equal credits, so our transaction is balanced. Let's look at our financial statement and see what it looks like. Notice that the only accounts with amounts are cash and common stock. Notice also that total assets equals total debt and equity. That part of our financial statement, the amounts above the line, is called the balance sheet. It's called a balance sheet because the left side is always in balance with the right side. The bottom part of our financial statement, with expenses and income, is called the income statement, or the profit and loss statement. After a few transactions, it will become obvious that accounts that usually have debit balances are on the left side of the page, and accounts that usually have credit balances are on the right side of the page. This is a tradition. Accounting is full of traditions. Traditions must be observed. In fact, accounting has formalized its traditions and called it Generally Accepted Accounting Principles. This is sometimes referred to as GAAP, spelled G-A-A-P. Sometimes laws are enacted that become part of GAAP. During this class, we will also show the debit amounts in green and the credit amounts in red. Now, let's pay some bills. Business always has bills when it gets started. Let's pay the rent for $500. That's not much rent, but it's all we owe. We have to account for it, so we debit rent expense for $500, and we credit cash for $500. Let's see how this affects our financial statement. The first thing we notice is that our financial statement is now out of balance. That means total assets no longer equal total debt and equity. We'll fix that in a minute. Before we do, notice that we credited cash. Remember, cash is an account that usually has a debit balance or a positive balance. Obviously, we can credit or debit any account. Think about it. If we could only debit cash, wouldn't that be great? Our cash would never go down. It would only go up. In the real world, we have to pay cash out. So we have to credit our cash account, sometimes more than we want. Okay, back to getting our financial statement into balance. First, we total up expenses. Then we calculate the net profit. Because we have no sales yet, we have a net loss of $500. This leaves our financial statement out of balance. What we have to do is to include earnings in our balance sheet. Once this is done, total assets equal total debt and equity. We are back in balance. The great thing about A-Systems software is that it does all of this automatically. We do the debit and credit side, and A-Systems software does everything else. Everyone with an account at the bank is happy when the bank credits our account, because when they credit our account, they add money to it. This sounds just the opposite of what a credit is supposed to do. What's going on here? Well, let's look at the bank's balance sheet and figure it out. When the bank adds money to our checking account, it actually increases the liability of the bank. They actually do a credit to their balance sheet, not ours. When we have money in the bank, they owe us that money. Isn't it nice to have the bank owe us money? Now let's get back to accounting. Let's buy a truck for $5,000. Well, that's not much of a truck, but that's what we can afford for our little business. We pay $1,000 down, and we finance the rest. For purposes of demonstration, we are going to put the $4,000 balance on a short-term loan. Let's take a second and discuss bank loans. Everyone knows about mortgages. They are long-term loans secured by real estate. Car loans are long-term loans secured by cars. Businesses often arrange short-term loans called lines of credit. A line of credit means the business has a pre-arranged bank loan that allows them to borrow amounts they need at their convenience. Payment terms are also pre-arranged. Usually the business has to pay it back after 90 days or 180 days, depending on what has been arranged at the bank. Sometimes a business will need money on a short-term basis, but not need an open line of credit. When this happens, a business can obtain a short-term loan, or a note, at the bank. Usually these are for 90 days. They are called commercial loans. Individuals may borrow money this way too, but they have to show the same kind of financial information that a business would. Back to our accounting. First, we debit fixed assets for $5,000, and then we credit cash for $1,000, the amount we paid. Then we credit short-term loans for $4,000, the amount of our short-term loan. Our balance sheet is now updated. Cash went down $1,000. Fixed assets went up $5,000. And short-term loans were added to for $4,000. This did not affect our income statement, our profit and loss. Some assets can be depreciated. What's depreciation? Well, it's where you write off the value of an asset over time. The concept is that certain assets wear out over time, so the IRS allows us to write them down. If we purchase a piece of equipment for $15,000 and figure to sell it for $1,000 after 7 years, we can depreciate $14,000 over 7 years. We can use any of several methods. The straight line method would allow us to depreciate $2,000 every year. There are several methods that allow us to accelerate our depreciation. Why would we accelerate depreciation? Well, let's consider a truck that produces a fixed amount of revenue every month. As it gets older, repairs mount up. The older it gets, the more it costs to keep it running. If we use accelerated depreciation, we would have lots of depreciation spent at the first and less later. As the truck ages, the cost of repairs will increase, making up for the lower depreciation costs. In this way, the cost of the truck would be level, matching the income. Talk to your tax advisor about which method of depreciation you should be using. So, we are going to depreciate $1,000 of the truck's value. We have to debit depreciation $1,000 and credit fixed assets or a reserve for depreciation for $1,000. Your tax advisor will know exactly how you should be doing this. When we recalculate our financial statement, we see that fixed assets have been reduced by $1,000. The truck is now net of depreciation, and our depreciation expense has increased our loss to $1,500. For our sample business, we are going to purchase some inventory, $20,000 worth. We need to debit inventory for $20,000 and credit accounts payable for $20,000. Accounts payable means we purchase the inventory from vendors on an open account, promising to pay at a later date, typically no longer than 30 days. Some vendors will offer a little discount if we pay the account in a hurry, say 1 or 2%. We need to recalculate again, and we see that inventory has increased by $20,000, and accounts payable has also increased by $20,000. We are in balance because we had a $20,000 debit and a $20,000 credit. Notice that purchasing inventory did not affect the profitability. The only time we make money is when we make a sale. We can lose money when we pay expenses when we have no income. So it's time to make a sale. We sell $20,000 worth of product to a customer who wants to pay within 30 days. We account for it by debiting accounts receivable for $20,000 and crediting sales by $20,000. Notice that this transaction takes us into profitability. We show earnings of $18,500, $20,000 in income, less the $1,500 in expenses. Actually, this is only half of the transaction. The second part to this sale is the cost of the sale, the inventory. We account for it by debiting cost of goods sold for $10,000 and crediting inventory for $10,000. Hopefully, we do not sell our inventory for the same price we bought it for. Of course, if we do not reduce our inventory, we have 100% profit. It'd be nice, but not likely. Now we see that our profit is $8,500, $10,000 less after we recognize the cost of the inventory. Well, it's time our customer paid us for the sale. How do we account for that? We get $20,000 cash, and we put it in the bank. We debit cash for $20,000, and we credit accounts receivable for $20,000. Notice that cash went up by $20,000, and accounts receivable went to zero. This transaction did not affect our profitability. Now it's time to talk about something important. Profitability is not cash flow. Profitability is what we get after we account for a sale we may not have yet been paid for, and expenses we may not have yet paid for either. Cash flow is money coming into and going out of the business. They are connected, but having a profit may not mean cash flow. All of your profit may be in accounts receivable, not yet collected. Now let's pay some bills. First, let's pay off the note on the truck. We debit short-term loans $4,000, and then we credit cash. This transaction is cash flow. It does not affect our profitability. Cash went down by $4,000, and the $4,000 short-term loan went to zero. Let's pay some more bills. Let's pay off the inventory that we bought earlier. First, we debit accounts payable by $20,000. Then we credit cash by $20,000. Again, this is cash flow, of course, all of it outward, not profitability. Our cash drops to $14,500, and our accounts payable is reduced to zero. If we're going to stay in business, we need more inventory to sell. So we buy $15,000 more in inventory. To account for it, we first debit inventory for $15,000, and then we credit accounts payable for $15,000. Now our inventory is up to $25,000, and our accounts payable is $15,000. We are still in balance. Again, this transaction was part of a cash flow, not profitability. If we were only to purchase everything for cash, and all of our sales for cash, our cash flow would be closer to our profitability, but still not exactly. The problem is that inventory purchases and purchases of assets are exchanging one asset for another. This does not affect profitability, but it does affect cash flow. Now we're going to learn something new called accruals. We need to accrue $2,000 for payroll. First, we debit payroll expense for $2,000. Then we credit accrued payroll for $2,000. An accrual may be an expense that you owe that you haven't paid yet. Sometimes you won't even have a bill for it. For instance, it's the end of the month and we're getting ready to do the payroll. Payday might actually be the first day of the month, but the employees are being paid for the last half of last month. Why do an accrual? Well, accountants love it when the expenses for a month are accounted for in the month in which they occurred, even if they aren't paid. The way to do this is by doing an accrual. The goal is to match the income with the expense associated with generating the income. This all occurs in the same accounting period. What is an accounting period? Well, usually it's a month. It can be a quarter or a half a year. Of course, it could even be a year. Because months are natural cycles, however, they usually make the best fiscal periods. Now, back to our $2,000 payroll accrual. First, we debited payroll expense for $2,000, and then we credited accrued payroll for $2,000. We should note that A-Systems software does accruals automatically. When we post our end-of-month payroll, it accrues in one month to be paid in the next. A-Systems software does a thorough payroll accrual, including Social Security and Medicare, federal unemployment, state unemployment, workers' compensation, tax withholdings, and the like. In our example, we are just going to demonstrate a simple accrual. We see that payroll expense is increased by $2,000. So is accrued payroll. We will pay this accrued payroll liability in the following month when we print paychecks. We won't be expensing anything because the payroll expense was already accrued. We debit accrued payroll for $2,000, and we credit cash for $2,000. As a result, cash went down $2,000, and accrued payroll went to zero. This covers many of the concepts and definitions that we need to know and understand in accounting. As time passes, we repeat the same processes over and over. We account for thousands of sales, hundreds of inventory purchases, payrolls every week, or as often as we do payroll. The transactions we do are routine, and there are very many of them. That's exactly what computers were made to do. Time passes and our accounting history gets big. We have 5,000 customers, 1,000 with open accounts. We have 150 suppliers, all with open accounts. We have 80 employees, each with a payroll history to be tracked. Things are getting complicated. How do we track all of this? We rely on A-Systems software. A-Systems software has journals. The accounts receivable journal tracks each of our customers, their individual purchases, their open balances, and their invoice numbers, and how much is due and when it's due. The general ledger shows only the accounts receivable balance, or the amount of all unpaid customer billings. All of the other details are tracked in the accounts receivable journal. We can see the aging there. The software has other journals too. The accounts payable journal tracks each of our suppliers, their open balances and the invoice numbers, how much is owed on each invoice, and when it is due. Again, the general ledger shows only the accounts payable balance, or the total of all unpaid vendor invoices. All of the other details are tracked in the accounts payable journal. We can see the aging there. The software also has a payroll journal that tracks each of our employees with their year-to-date earnings. It also prints a W-2 for each employee at the end of the year. Again, the general ledger only shows how much payroll has been accrued for payment. All of the other details are tracked in the payroll journal. Journals are important because they track the details of every transaction. What about budgets? Without budgets, how do you plan for the future? Or know what you need and when you need it? They have a word for companies who work without budgets. That word is bankrupt. Budgets should be SOP. Successful companies use SOP, Standard Operating Procedures. Small companies often use SOP too, Seat of Pants. Of course, seat of pants is an excellent recipe for failure. What about contractors and budgeting? Contractors have their own budgeting and accounting methods, called job cost accounting. Some just call it job costing. What is job costing? Well, it's a simple process of budgeting the costs of every phase of the job and then comparing actual costs as they occur to the budget. Well, how is budgeting done? It's very simple. Every job starts out as a bid. The bid is based on an estimate of how much the job will cost to build. The estimate will become the budget when the bid is won. The estimate is created by a visionary person called an estimator. An estimator has great insights into actual costs, the time necessary to do each phase of the job, and a myriad of other details. How do estimators track all of these details? Well, they break down the job into tasks, phases, groups of steps in a construction process. Each task, phase, or step is a separate cost and has its own unique numerical code called a cost code. Cost codes are standardized for all types of contractors. Each specialty has its own unique set of cost codes. The Construction Specifications Institute, or CSI, has its own list of cost codes used by many contractors. This is called the CSI Cost Code Dictionary. Cost codes are numerical, with a letter at the end of the code that tells a little bit more information. For example, we have cost code 30001, which represents a specific task having to do with concrete. Cost code number 30001L represents labor costs for the task. 30001M represents material costs for that same task. Following the pattern, 30001S represents subcontract costs. 30001E represents equipment costs. 30001G represents general costs. And 30001B represents burden costs. What's a burden? Well, burden is overhead assigned to that task or job, usually from indirect costs. An indirect cost might be the cost of running the office. It certainly is not part of the job, but there's no way to build a building without someone to pay the bills and do the payroll. Contractors have direct and indirect costs. Direct costs, as we've talked about, are labor, materials, subcontract, equipment, and other types of costs. Indirect costs include office rent, estimating. It could actually be assigned to a job, but what about the time spent estimating jobs that are not won? Indirect costs can be added to direct costs as burden to the job. For instance, if the overhead amounts to 3 cents for every dollar spent on direct costs, then it might be appropriate to assign a 3% burden directly to the job. Now it's time for a review. Accounting is a numerical history of our business. The history is called the profit and loss, or the income statement. Accounting presents a numerical photograph of our business, its status. This numerical photograph is called the balance sheet. Together, the income statement and the balance sheet are the financial statement. Accounting is always a two-step process. Every transaction has a positive part called a debit and a negative part called a credit. Debits and credits offset each other. Journals track individual transactions, and summaries of the journals are posted into ledgers. The purpose of accounting is to tell us where we are and how we got there. Without accounting, we are running our business by the seat of our pants.